Welcome back to the Deep Dive, where we take a complicated stack of research and turn it into the essential knowledge you need to be ahead of the curve. Today, we are looking at one of the most baffling paradoxes currently playing out on Wall Street.
It really is.
You've got the broader market, the S&P 500, hovering right near all-time highs. It's just a picture of relentless market exuberance. Yet at the same time, one of the biggest, most recognizable brands on the planet, Nike, has been in an absolute years-long stock massacre since its peak back in November 2021.
And this is such a crucial deep dive for any investor, or really anyone who's curious, because the Nike story is so much more than just a retail or a sneaker analysis. It's a perfect case study in investor psychology and market cycles and the critical difference between a strong brand and a functioning stock. So our mission today is to unpack the quantitative damage, the real numbers. Then we'll analyze the dramatic shift in who the typical Nike investor even is anymore. And finally, we'll critically assess whether the company's current kind of desperate win-now turnaround strategy actually has a viable path to success.
Essentially, we're trying to pull out a universal lesson here, something applicable to any stock, especially right now in this highly momentum-driven market. We want to know, when does sentiment crush fundamentals, and when does the reverse happen? Okay, let's unpack this. Let's start with the simple, brutal reality of the stock price itself. It has been an absolute relentless march downward.
It truly has. I mean, the decline is not just a dip. It's this persistent erosion of value.
Yeah.
Since the beginning of 2022, Nike has just relentlessly shed value. If you summarize the damage across 2022, 2023, and 2024, the stock has lost roughly 65% of its value in total.
65%?
Yeah, and that includes 2 years, 2022 and 2024, where the stock dropped nearly 30% each time.
I mean, that's the very definition of a continuous bear market for a single stock.
Exactly. And when you have that kind of persistent decline, patience, which is, the most valuable currency in investing, it just inevitably evaporates. Investors stop focusing on the long-term fundamentals, like the fact that everyone globally recognizes the swoosh.
Sure, the brand power.
And they start reacting purely to immediate negative sentiment. The overwhelming feeling becomes, the pain is not over, I need to sell now.
And that brings us right to the core lesson of this entire deep dive, doesn't it? The clash between psychology and fundamentals. We're constantly told that over the long term, earnings drive prices, but the short to medium term, that's almost entirely dominated by emotion and perception.
Precisely. And the truly fascinating shift here is that the stock price action has gone totally wonky because the core type of investor buying Nike has completely changed. When a company's primary buyer profile changes, the stock just acts unpredictably. We have to understand who was buying then versus who's buying now.
That makes perfect sense. It's a behavioral question. But why does that shift matter so much? If the underlying business sells billions of dollars worth of shoes and apparel, why does it matter if my patient grandmother or, some highly aggressive hedge fund quant is buying the shares?
Because different investors value completely different things. They're willing to accept different levels of risk and different growth prospects. We're contrasting two types of market behavior here. Patient capital that's seeking income and stability versus aggressive capital that wants revolutionary change.
So give us the classic contrast, the steady hand versus the high roller.
Okay, think about the classic difference. The Coca-Cola investor versus the NVIDIA investor. The Coca-Cola buyer is not chasing a roaring market. They're looking for downside risk protection and a reliable, growing income stream. I mean, Coca-Cola has raised its dividend for more than 6 decades. Stability is their primary currency.
Okay, so Coke investors are the safety players. They are totally fine with single-digit growth if it comes with rock-solid reliability.
Correct. Now, the NVIDIA investor, they are seeking outsized, exponential gains based on technological disruption. They're willing to pay an extremely expensive sky-high premium for that potential because they believe the total addressable market is going to multiply tenfold.
Now bring this back to Nike. For decades, Nike was seen as the NVIDIA of apparel, right? It commanded this massive premium. Its investor base was chasing consistent, global, high-margin growth.
Absolutely. Nike was a growth stock through and through. The premium valuation was earned through its brand power, its strong margins, and that unparalleled global dominance in footwear. The old Nike investor wanted reliable, steady global expansion. But now that growth has hit serious speed bumps, that growth-oriented investor has packed up and left.
Wait, but if Nike's brand is so powerful globally, shouldn't they be immune to this buyer profile shift? Isn't the brand itself the ultimate downside protection, even if growth slows down for a bit?
That's the core tension. You're right, the brand is immensely powerful, but the stock market values execution and future growth potential above everything else. When the execution stumbles, the valuation has to fall until the new buyer, the deep value buyer, decides it's cheap enough. We even saw this kind of shift happen inside a company like Broadcom, which was known for steady diversification. Its stock took off when its booming AI business transformed it almost overnight into a high-octane growth favorite. That shift in perception changes everything.
So if the old investor wanted premium growth, the new investor, the one currently setting the price, is betting on a painful turnaround. And a lot of that turnaround pain stems from the failure of their once celebrated direct-to-consumer or DTC strategy.
This is so critical. During the pandemic lockdowns, the DTC business, which, means selling directly to the customer through Nike's own online channels and physical stores, cutting out retailers like Foot Locker,
Yeah.
it absolutely thrived. It looked like the future. Management saw higher margins and, greater control over branding and pricing.
That's the theory, right? Cut out the middleman, pocket the difference. But the execution failed to sustain that momentum.
It failed dramatically because the high margin theory ignores the massive hidden operational complexity. When Nike went DTC, it didn't just gain margin, it inherited all the expensive, difficult tasks that wholesalers used to manage.
And what specific tasks are we talking about here?
Well, everything. Everything related to logistics, inventory, and capital expenditure. Wholesalers like Dick's Sporting Goods or JD Sports, they carry the risk and cost of holding massive amounts of seasonal inventory. When Nike took that over, they had to spend heavily on supply chain upgrades, warehousing, managing the cost of free shipping, and the absolute nightmare of processing returns. Suddenly, Nike became a logistics company as much as a brand company.
And when that pressure intensified, when consumers started pulling back on their spending, those cracks showed up fast.
Precisely. The DTC business simply hasn't been able to offset the decline in their legacy wholesale business, which is still massive. This led directly to what we call margin compression.
Let's define margin compression clearly for everyone listening. What does that actually look like on the ground?
It means they're forced to sell products below their target price point just to clear the warehouse and move stale inventory. They're sacrificing profit per shoe just to keep the inventory flowing. Their current product mix just isn't resonating enough with cost-conscious consumers to command the premium prices they used to get. This forced discounting, combined with the higher operational costs for DTC, is a 1-2 punch that just kills profitability.
So that structural shift, compounded by innovation challenges, is why the stock is no longer treated like a premium growth vehicle. The market sees a company that needs deep remediation. It is officially in full turnaround mode.
That's the language, because investors have lost confidence in their ability to deliver on promises and regain market share. A turnaround at its heart is dramatic strategic shift. It's an admission that the previous business model is broken and needs total reconstruction.
It's helpful to anchor this concept with examples. When we talk about a turnaround, what's the gold standard of success?
Oh, look no further than Microsoft in the mid-2010s. They were seen as this stodgy, legacy giant totally reliant on Windows licensing. But under new leadership, they executed a dramatic strategic pivot. They shifted away from just traditional software sales to a comprehensive cloud computing empire with Azure. They embraced cross-platform integration, and they made savvy, transformative acquisitions like LinkedIn and GitHub. They rebuilt themselves from the ground up into a high-margin, futuristic cash cow.
A total reinvention of their core revenue stream.
Right.
Now, what about the cautionary tale, the failed turnaround?
Blockbuster.
Of course.
Their business model, physical media rental, was rendered completely obsolete by the digital distribution of Netflix. They failed to execute the strategic shift that was necessary to adapt. They made minor tweaks when they needed an earthquake.
So Nike needs to pull a Microsoft, not a Blockbuster. What is their earthquake? What is the core of their strategy right now as defined by management?
It's dubbed the Win Now strategy. It's an explicit focusing exercise. They're basically admitting they spread themselves too thin. The strategy centers on returning to their core competitive strengths. Not overexpanding into every possible lifestyle niche, but doubling down on running, football, basketball, training, and other essential sports categories.
That sounds good on paper, but turning a ship this large takes incredible commitment and, well, a lot of capital. How are they executing this Win Now plan day to day?
The execution involves several key tangible levers. First, cost reduction. They are streamlining their workforce and operating costs heavily. Second, improving the entire supply chain to reduce that massive inventory glut that led to the margin compression. And third, meticulously monitoring the marketing budget to make sure every dollar spent targets those core, profitable consumers.
And I assume, most critically, they have to revamp the product portfolio with genuine innovation that gets people excited again, not just new colors, but new performance technology.
Absolutely. The win now strategy means doubling down on innovations like the newest generation of the air zoom lines, focusing heavy marketing spend on specific kits for major global tournaments like the upcoming World Cup, and ensuring their foundational basketball and training footwear reasserts dominance. They need those must-have products to start moving through the DTC channel at full price again.
Okay, here's where it gets really important for the potential investor. Given the years of decline, you mentioned that patience is gone. So to get excited again, investors will need to see much more than just a single quarter or two of improvement. They need certainty that this turnaround is actually sticky.
And we have to acknowledge the current hard difficulties. With margin compression still a major issue and struggles continuing in key markets like China, where sentiment is highly complex, assuming a magical recovery in the next 12 months would be, well, naive. We got a brutal reality check recently. The stock fell 10.5% the day after they reported earnings because management actually expects revenue to decline slightly in the upcoming crucial holiday quarter.
A revenue decline expectation during the most important sales period of the year, that speaks volumes. It shows a loss of confidence in the depth of the challenge they're facing. So if immediate growth is off the table, how do we even value this company right now?
This is where long-term conviction applies, especially for you, the individual investor. You don't need to abide by Wall Street's impatient quarter-by-quarter timetables. The immediate valuation challenge is complex. I mean, valuing Nike based on trailing earnings, what they have earned, or forward earnings, what analysts expect them to earn, is tricky because the business is so beaten down, those numbers look artificially terrible. You have to look past the immediate results.
So if you believe in the long-term power of the brand, what are the investor options here? How should someone approach this?
We can break the decision into two main camps. First, you have your traditional value investors. They're highly prudent. They will choose to wait for the actual improvements, the confirmed margin expansion, the undeniable product portfolio success to materialize before they jump in. They prioritize certainty over maximizing their potential profit.
Okay. And the second camp, the high-conviction players, the contrarians.
These are the deep value investors. They can choose to scoop up shares now, accepting the short-term risk of volatility for the potential long-term upside once the turnaround is fully validated. The huge upside is that they're buying at a price that's just depressed by negative sentiment. Plus, for diversification purposes, they're collecting a sizable 2.7% dividend yield while they wait for the win now strategy to play out. That yield acts as a partial cushion against further volatility.
That dividend definitely offers some comfort. But amidst all this pain and talk of decline, we do need to highlight the fundamental good news here. The business has at least stabilized.
That's the crucial takeaway. It's no longer in free fall. It has stabilized and is forming a foundation upon which the win now strategy can actually build. The market just needs clear, undeniable evidence that that foundation is solid and that the execution risks are receding.
So what does this all mean? The recovery is tied directly to investor conviction and margin improvement. Nike will almost certainly begin to recover once investors are convinced that the margins are improving and they're convinced the worst of the cost and inventory problems are definitively behind them.
Conversely, it could absolutely remain beaten down for longer if consumer spending pressures persist, if a recession hits a key market like Europe, or if external issues like trade tariffs continue to drag on those crucial margins. The core decision boils down to whether you believe in Nike's unparalleled brand strength, its newly defined win now strategy, and its long-term ability to execute, independent of what the market is dictating in the next 2 quarters.
It's a massive risk-reward calculation. And considering how premium priced the rest of the stock market is right now, you have very few opportunities to buy high-quality companies at a discount driven purely by bad sentiment.
That's right. And that brings us to our provocative final thought for you to chew on. The core question isn't if Nike's brand is strong enough to eventually recover. I think most people agree that it is. The real question is this: are you willing to sacrifice the certainty of improved results for the significant advantage of buying a stabilized, world-class business when everyone else has already lost patience? That is the essence of deep value.